Hi everyone, today we're going to talk about Wish and if Wish stock is a buy. So this company has had a bit of a rough time recently on the stock market, and since its IPO last year the stock has gone down a fair bit, and today we're going to take a look into it and see if it's a good opportunity to buy. I'm looking at this as a long-term perspective, and yeah, I'm going to see if this is a good opportunity in my opinion. I've not really looked into too many new companies recently, so yeah, I think it's good to get back to looking at some new stocks and just see if they're good opportunities. So if there's any stocks that you guys kind of want me to research into, just comment them down below, and if there's a really popular one that gets a lot of likes, then I'll consider doing a video on it. So yeah, I looked into Wish probably 6 months ago on the Patreon, and I posted my thoughts there, which at the time I didn't think it was a buy, but it's gone even lower since then, so I thought let's have a re-look into it, and today I thought I'd share it with you guys on YouTube and my thoughts on it in general. Now Wish I don't think needs too much explaining. I'm sure it's a company that you guys have probably heard of, and they are very big on their advertising, especially on Facebook. I'm pretty sure you see Wish adverts all the time, and we'll actually be talking about the marketing budget a little bit later in this video, funny enough. But yeah, Wish's e-commerce site, it's very well known, they're very big on the marketing. Sometimes it does get a little bit of the bad reputation as well, I'm sure you're aware of. There is quite a few memes that go around, and just had a quick Google of a few before I even came on to do this video, and you'll see there's yeah, sometimes they have a bit of reputation of having products that don't actually turn out to be what you actually ordered, and sometimes you'll see a few products and you go, what even is that? I mean, I don't know, there's a few products on there that it's just very strange products, let's put it that way. But enough of that, we'll take a look into the company and we'll see if this is a good opportunity to go buy this one. So if we go into the stock chart, you can see here the ticker symbol is Wish, and the company is actually called Context Logic. But it's always catchy to put Wish, I guess. So it's currently trading at $6. You can see here it's currently down 70% overall. It came onto the stock market, you'll see here, just in December time. Came on at $23, or that's where it closed on its opening day, and it did okay, and then eventually we just had a massive fall off the cliff. It's down 70% since it came onto the stock market, which is huge. Now I am going to jump a little bit here, and part of this was on their recent earnings, and obviously part of it in general is that small market caps have been hurt a huge amount. You know, any company that is kind of below 10 billion at the moment, you guys know, is massively out of favour. So it's currently, you know, 4 billion market cap company, and I will say this here, obviously I'm going to be talking about this from a long-term point of view, but just in the short term, when you've got a company that's down 70% and a lot of these small market cap companies out of favour, just in the short term there is a chance that this could actually, you know, when this used to be 23 and it's now 6, there's a chance that it could just pop up, you know, 30-40% as people start to rotate back into small market caps, and there'll be probably a few people that look at a company like Wish and go, you know what, it's down 70%, I'll just take a shot at it. You know, a bit of a gamble really. Now that's what will happen in the short term, and I don't want to do that. I kind of want to look at this as a 2 to 5 year investment, but I thought I'd just make them 2 points very clear. Now, the company is pretty much near 52e close. There is currently no P ratio because it doesn't make profit, so that's worth noting. Now, just going through its revenue growth, its profit growth, if we just go back previously, before it was even in the stock market, the company normally, well, has historically made a lot of losses. You'll see here, the burn through anywhere between 100, 200, 300 million, and in fact at the moment it looks like they could be burning through nearly close to $1 billion, which is actually quite scary to think about. And on the revenue point of view, it's gone from it used to grow pretty fast. In 2017, you can see we did 1 billion, then we popped up to 1.7 billion, so that was fantastic growth. And then with a little bit of a slow year in 2018 to 2019, obviously what happened, we had the CV, obviously that's going to help sales because they went on to e-commerce. So as you would expect, you did have a little bit of a pop with revenue growth here and some fantastic numbers. So the revenue growth is historically very mixed. You've had years of very good growth and you've had years of not much growth, so that's a little bit strange here. And you can see here just right now recently actually, because it's had a lot of demand pull forward, you'll see the revenue is actually slightly declining, but the earnings is probably one thing to just worth noting, is that, you know, it does lose a fair bit of money. Balance sheet wise, I was actually really surprised how healthy this is. Assets to liabilities are pretty strong. There's no debt on there, so 0% debt to equity, which is good. You've got 1.6 billion in cash. So considering this is actually a 4.4 billion market cap company, and they've currently got around about 1.6 billion in cash, that's pretty good going. Very strong cash pile. Obviously, the thing is that you're going to say is they're probably going to need it because they're burning through a lot of money, and that cash pile is going to get burnt through very quickly. But from an actual health point of view at the moment, it's not too bad. No debt on there, very strong cash position. The only little worry that I would have is that if they carry on losing the amount of money they are doing, they are going to burn through that balance sheet. What will happen then? They'll need to raise capital. Do they take that on through debt, or are they going to dilute shareholders? That's the only thing that I would be worried about in the longer term of past 2 years if they don't get to profitability anytime soon. And on the future growth side of it here, you can see the actual revenue is actually supposed to decline this year, which is really surprising. You'd think that after having so much growth, you would be able to keep them users and keep them reordering from you. So to see an e-commerce company like this, even though they're very hard numbers to beat, you would hope they would pretty much still have some sort of growth here. And obviously these are analyst predictions, but we are halfway through the year. But you would hope for probably better numbers than this. Obviously losses are still going to be strong, predicted at 419 million. And then it's going to pretty much get back to where it was in 2022, and then in 2023 we'll kind of go past to where we were. So just from what analysts are kind of predicting, and we've even got some of these numbers already this year, a little bit worrying about the growth side of it declining. Now on the management side of it, you do have a founder-led company here who is the CEO, and you can see that he owns 8.9% of the company, which is the second largest shareholder in here, which is pretty good going. The only little thing that was a little bit worrying is to see that when the stock kind of came onto the stock market was to see the CFO pretty much get rid of half their position in the company, which is a little bit worrying. Sometimes I don't worry too much about insider selling, but when you see an insider or the person that's in charge of the finances, and then you see revenue declining and you're seeing them dump half of the shares, I don't like to make too much of a big of a deal, but you do kind of look at that and go, that's a little bit worrying. But yeah, just thought I'd just kind of mention that. Now, if we go back to the share price, you can see, especially over the last kind of since June time, the stock has lost half its value. It did have a little bit of a good pop here, and this is what I mean previously when I said, in the short term, this could happen. Anytime this could happen where people see this company at $7 and now it's $6 and think, you know what, let's try bottom pick this, and it goes up 80%. I'm trying to look at this as a long-term investment, but that could always happen. But when you kind of do that kind of thing as well, you do have to be careful that boom, it can go down pretty quick as well. Now that recent drop here especially was off their recent earnings. So the recent earnings were the EPS missed by 4 cents, and they misses on revenue. So the problem is with Wish at the moment is you've got a lot of small market cap companies that have been hurt a huge amount. But the problem as well with this one is the earnings are terrible. It's quite common for a lot of these small market cap companies to bring out amazing earnings and then they go down. This actually probably deserves to go down because these earnings were actually really bad. You'll see here that they missed on EPS. You can see here the revenue was quite a big miss as well, and once again, like I said previously, is analysts are predicting that it will struggle for revenue growth, and you can see here it's actually happening. The revenue growth was down 6%, which is kind of worrying because you'd think after the growth they have had, they would keep customers and still kind of, they probably won't have as much growth, but you'd think they'll kind of do a bit of a Etsy or Amazon where they still grow probably 10-20%. So the fact that it's actually declining on revenue is probably a very worrying thing. And if you look into the company here, you can see the core marketplace was down, product boost wasn't too bad, marketplace revenue was down, and logistics revenue is growing at a very healthy rate. This is something that's actually really good with the company, is that they're actually trying to bring a lot of the logistics into the company now, because obviously what really where at the start of the video where a lot of the memes kind of come from this company is that the problem is the company gets a lot of their products from China, and because they come from China, the logistics time for them to get across is a massive problem because they take a while. Now if they can improve the logistics and they get products a little bit quicker to the people that are ordering them. That's probably one of the big problems solved right there. But going back to the previous point, you can see here in the recent earnings report, this is the big problem here. Is you look total monthly active users, or MAUs, declined 22%. So there's definitely a bit of a big problem here with users not sticking to the platform. So you're looking at an e-commerce platform, people are still going to use e-commerce. Sure, people might be going out now and then, but when you're an e-commerce platform that pretty much sells everything, there's definitely a problem here where people aren't sticking to this platform and using it. And the scary thing is they actually haven't given any more outlook now. You can see this comment here about the revenue outlook, and it says here, to provide some context, quarter to quarter to date, total revenue through July 2021, so this is actually going into Q3 now, was down approximately 40% compared with the prior quarter. So the thing is the earnings report that has just come out was bad reading, and then the outlook has got even worse, which is a massive problem. Now we're starting to hear this a little bit more, is that they are going to spend less on digital ads, because they are getting a little bit more expensive. We've heard a few similar things for people that do rely on a lot of their digital ads at the moment. But this is one of the big problems that they've got going on here with the companies. You got revenue here of 656, the cost of revenue is 272. But the problem is you're spending here 396 million in marketing. That's a massive marketing expense, and this is something they've done for quite a long time. The problem is if you keep spending a lot of money to try and get customers, you need a lot of them customers to stick. Otherwise, you just keep marketing, you get customers, they order products, and then they don't carry on ordering, and you're just trying to keep getting new customers all the time, and people aren't sticking to the platform. For a company like Wish to become profitable, what they need is to kind of reduce the sales on marketing, or get to a point where the people that are sticking to the platform kind of outweigh the marketing spend, and then the losses get smaller and smaller. But as you can see previously when we were talking about the company, the big problem that these guys had is that the revenue is going up and up and up, but the problem is earnings are just going down and down and down, or staying the same, because people are not sticking to the platform and reordering from this platform at the moment. And I think this kind of sums it up here, where Wish, you can see here they've got 2.5 stars. Now obviously reviews are always going to be quite negative, because I always say, why do most people leave a review? It's probably because you've had a bad experience and you don't want people to use it. If you have a good experience with a company, then you probably will not bother to leave a review, and that's always something that I do take into consideration. But just to give you a bit of example here, you can see Wish has 2.5 stars. If I was to just search for Amazon, you can see Amazon here has 4 stars. So you can see there's a big massive difference between a company that is very similar in the e-commerce space that has a lot better reviews. You could do the same for another big player in this space, which is Etsy. If we go on Etsy, you can see these guys have 3.5 star reviews, so a little bit less than Amazon, but still much better than what Wish is doing. And another competitor here, which is eBay, you can see these guys have a lot higher rating than what Wish do. Now, because the company isn't making profit, there's not too many metrics that we can use to kind of see if this is a good valuation. Obviously, probably one of the big things that I kind of like to look at is looking at what the total enterprise value to revenues is, and you can see here that when it came onto the stock market, it wasn't terrible. It shot a little bit higher, and now you can see that it's lowest it's ever been, but once again, it's recently new on the stock market, and it's trading around about 1.48, which isn't too bad. If this was a company that I liked, this sort of valuation, I would actually really consider actually picking this one up. So yeah, it's not a terrible valuation from what information we do have, but like I say, it's very limited because of the time it's been on the stock market. So I guess that kind of takes us to the ultimate question, where is it a buy? And in my opinion, when you look at the stock price and the chart and how beaten down it is, it's the lowest it's ever been, which you would normally think a dip's probably a good buying opportunity. You look at what the value is on the enterprise value at the moment, it's very low. When that kind of gets round to the 1, 2, 3 range, I'd be saying this is a screaming buy. But for this one, when I look into Wish stock, I still see a few problems that makes me nervous to buy into it. I think the fact that there is so much profit that's or they're losing so much money, and it doesn't look like changing anytime soon, and that will probably burn through the balance sheet. Not a huge fan of that. revenue, I think the problem is with the revenue is that obviously you can see that it's declining, and the fact that it's declining is looking like they cannot stick users at the moment, and that would need to change for me to consider buying that one. Balance sheet is pretty good. The earnings were obviously the big worry. You know, you look at the outlook is atrocious, and the thing is as well is when you look at this company, the reviews are really ugly. The big problem with this company is that people look like they're going to order from the site and they're looking and think, the problem is it's taking too long for me to get my product, and also that there's a lot of complaints that a lot of these products are cheaply made, and that kind of all ties in with the company is that the revenue is going down because people are buying products and it's taking too long for them to come. Now they are trying to improve that, and if I carry on seeing improvement, I might change my decision later on, which at least they're trying to address it, but at the moment it's still too big of a problem for me. And also that the products are not great review products, so yeah, they need to kind of improve that as well. And that just seems to for me, just showing up in earnings right now because they're struggling. The problem is they're having to put so much marketing in because they need to acquire new users to spend, but when the new users do come to the platform, they look at the platform, they buy stuff, and they're just not impressed with the product, and it's not sticking. And for me, it just looks, when you look at the other competitors in the space, your Amazon, eBay, Etsy, you know, if you wanted to buy from them products, you get them so much quicker. Sure, they're a little bit more money, but they're a lot better products and you get them quicker. And I think that's a bit of a problem until Wish, which it looks like they are trying to kind of sort that out, but it's still miles off where I want it to be, and that's showing in the numbers. Until they sort that out and improve the products and how long it takes to come, I think they're going to be having a losing battle here and still burning through the money, having to spend on marketing, and it's just a bit of a problem for me at the moment. So at the moment, while it's kind of at this position, I can't buy it at the moment. It's one that I'm going to add to a watch list, and I'll see further down the line if they do improve what's kind of going on here. Because you look at where the company's at and the valuation, it's absolutely fallen off a cliff now. So it's kind of like, it's one of those that you look at and go, is it worth a punt? But yeah, until the fundamentals of this company improve, I can't touch it. But if they do improve and the share price is here where it is, then I would consider buying it. But at the moment, it's one that I would not touch, and I'm just going to leave it. And you know what? I'll come back to in probably a year's time and see where it's at, and if they've improved, then maybe it's a buy then. But at the moment, for me, it's not one that I can touch for the reasons that I just said. So yeah, hopefully that was a little bit of a quick recap into Wish, and hopefully it's useful and some information there. Let me know what you think about the company. Let me know if you're buying the company as well in the comments. But I hope you enjoyed it. If you could, hit the like button. If you're new, subscribe. If you do want to start investing, there's some links to some brokers in the description, like Stake, like Free Trade. You join through there, you get a free share as well. With the Stake one, you actually get 2 free shares at the moment through August. But that's the video for today, guys, and I'll see you in the next one.